welcome back to the channel. If you've been thinking the US economy was finally settling down and finding its rhythm, well, you might want to hit pause on that thought. Today's financial headlines are throwing a few curveballs, and they're shaking up what many of us, especially investors, thought we knew about stability, inflation, and market confidence. Deep into the Federal Reserve's latest signals on interest rates, unpack Wall Street's dramatic swings, and reveal just how fragile our economic recovery truly is. These updates are absolutely crucial because they shape America's economy right now. And, more importantly, they impact your money directly. So grab a coffee, let's get into it, and break down what's really going on. The Federal Reserve is, once again, front and center. Why does this matter so much to you and me? Well, higher rates for longer basically means borrowing money continues to be more expensive. Whether you're dreaming of buying a home, running a small business, or simply managing your credit card debt, the cost of that money stays elevated. The message from the Fed is crystal clear. The road to truly lower inflation is a marathon, not a sprint, and our economy still needs to prove it can handle this continued financial restraint. Analysts are already suggesting that this decision could really test consumer spending, especially as we head into the crucial holiday season, a time when many Americans traditionally rely more on credit. To voice concerns that tighter wallets could impact their sales, and banks are reporting a noticeable uptick in late payments. Wall Street is busily reevaluating its expectations for 2026. Some economists are now forecasting slower growth, but perhaps fewer dramatic market shocks as a result. Some stance might frustrate some investors eager for relief. Many experts agree that it's probably the right move to prevent another dangerous inflation spike. Most wisely put it, this is the price of stability. Patience. Swallow for some, but it's about securing our financial future. Let's talk about where things could get a little serious. The period of high interest rates has the potential to deepen the financial divide between those who are benefiting from higher savings yields, which is a nice perk for some, and those who are really struggling with increasing debt burdens. Numbers on a screen. It's a delicate balance that could fundamentally reshape America's financial landscape well into next year, and that requires careful monitoring and understanding for all of us. Where today got really interesting, the real surprise actually came from Wall Street itself. An uncertain morning session, stocks staged a dramatic rebound by the afternoon. Industrial average closed higher, getting a significant boost from tech and energy stocks, which showed impressive strength. 100 followed suit, snapping a 3-day losing streak, which was a welcome relief. The Nasdaq, it absolutely surged, with major players like Apple, Microsoft, and Nvidia delivering stronger than expected quarterly earnings that clearly impressed investors. Investors collectively decided to shrug off the Fed's cautious tone, at least for today, describing this rebound as a hope rally, built on the optimistic expectation that strong corporate profits can indeed withstand these higher borrowing costs. To the underlying strength and innovation of these companies. Let's be clear. Volatility remains a very key theme in our current market. In treasury yields or new inflation data could easily swing sentiment back in the other direction in the coming days. Perfectly, saying, we're dancing between optimism and reality and the music just keeps changing. An unpredictable environment, to say the least. With uncertainty, institutional investors are positioning themselves with caution, shifting their portfolios toward traditionally defensive sectors like healthcare, utilities, and consumer staples, seeking a bit more stability. Retail investors, ever eager for opportunity, continue to chase those short-term gains, especially in exciting tech and AI-driven stocks. Tug of war, happening right before our eyes. Fundamentals versus momentum. Momentum seems to be having its moment in the spotlight. It's fascinating to watch these different strategies play out in real time. Americans, the biggest and most impactful story isn't about Wall Street's daily judgment. It's much closer to home. It's the relentless cost of living. Recipients, in particular are bracing for a smaller cost of living adjustment, or COLA, in 2025. To be just 2.6%, a noticeable decrease compared to last year's 3.2%. In real terms, smaller increases in monthly checks, even as the prices for absolute essentials like groceries and rent remain stubbornly high. That seniors living on fixed incomes could feel this squeeze even more sharply as we head into winter. The administration states that this adjustment reflects cooling inflation, but many retirees understandably argue that this calculation just doesn't fully capture their real-world, day-to-day expenses. Agree, acknowledging that official data can sometimes lag behind the actual lived experience of households. Here is clear. While inflation might be slowing down on paper, its shadow still looms large and impactful over American households. Retirees, this news hits home, quite literally. Let's talk about one of today's other big trending financial stories. Oil prices climbed above $89 a barrel today, driven by renewed supply concerns stemming from the Middle East and ongoing production cuts from OPEC+. What oil prices mean for you? It's directly into higher gas prices at the pump, which could add another layer of pressure to consumers who are already feeling stretched thin. Analysts are forecasting that prices could remain volatile through the end of the year, heavily dependent on evolving global tensions and overall demand trends. A powerful reminder that even as the U.S. economy shows signs of stabilization in some areas, global forces can quickly and dramatically shift the entire economic equation. After all of this, where does it leave the markets and our economy as a whole? In one word, uncertain. Certainly showing impressive resilience, which is a fantastic sign, but it's also walking a very fine line between continued progress and persistent pressure points. Cautiously optimistic. Households are understandably watching prices with extreme care, and the Federal Reserve is holding its ground firmly. This is the story of the moment. An economy that appears steady and calm on the surface, but is clearly churning with dynamic forces underneath. For today's comprehensive U.S. financial briefing, helps you understand the bigger picture. Information valuable? Please hit that like button, share it with a friend, and don't forget to subscribe so you don't miss our next update. Ours could bring even more surprises for investors. So stay tuned, stay informed, and we'll catch you in the next one.